What if I told you that $10,000 invested 30 years ago could be worth over $182,000 today? Not through luck, not through gambling, but through one simple strategy that anyone can use. Yet 70% of people never invest in the stock market because they think it's too complicated or too risky. I'm here to tell you that's completely wrong. By the end of this 10-minute video, you'll understand exactly how the stock market works and how you can start building real wealth today, even if you only have $10 to invest. Quick favor, hit like and subscribe right now so YouTube shows this to more people who need to see it. Let me start with the absolute basics. The stock market is simply a marketplace where people buy and sell shares of companies. Think of it like an auction house, but instead of buying antiques, you're buying tiny pieces of actual businesses. When you buy a stock, you become a partial owner of that company. If the company does well, your investment grows. If it struggles, your investment might decrease. It's that simple at its core. Now here's where it gets exciting. You make money in the stock market through two main ways. The first is capital gains. This means you buy a stock at one price and sell it later at a higher price. Imagine buying Apple stock at $100 per share and selling it at $150. You just made $50 per share in profit. The second way is through dividends. These are payments that companies make to shareholders from their profits. It's like getting a paycheck just for owning the stock. Some companies pay you every 3 months just for holding their shares. But why do stock prices move up and down in the first place? It all comes down to supply and demand. When more people want to buy a stock than sell it, the price goes up. When more people want to sell than buy, the price drops. But what drives these buying and selling decisions? Company performance is huge. If a business is growing its earnings and expanding operations, more investors want in. Economic news matters too. Reports about inflation, unemployment, and interest rates shape what investors expect about future profits. Then there's geopolitical events like wars or trade tensions that create uncertainty. And honestly, emotions play a massive role. Fear and greed drive a lot of short-term price movements, which is exactly why most traders lose money while patient investors win. Let me explain the two main types of stocks you need to know. Common stocks are what most people buy. When you own common stock, you get voting rights on company decisions, you benefit when stock prices rise, and you might receive dividends if the company chooses to pay them. The downside is that if the company fails, common shareholders get paid last after everyone else. Preferred stocks are different. They offer fixed dividend payments regardless of company performance, which makes them attractive for people who want steady income. Preferred shareholders also get paid before common shareholders if the company goes bankrupt. But the trade-off is limited growth potential and usually no voting rights. For beginners, common stocks are typically the way to go because they offer unlimited growth potential. Now let's talk about the S&P 500, which is probably the most important investment benchmark you need to understand. This index contains 500 of the largest U.S. public companies. These companies account for roughly 80% of the total value of publicly traded U.S. stocks. It includes companies from every major sector: technology, healthcare, consumer goods, finance, energy, and industrials. Basically, when you invest in the S&P 500, you're investing in the entire U.S. economy. Here's the impressive part. Over its lifetime, this index has returned an average of roughly 10% per year. But, and this is critical, not every year is positive. In 2002, the index dropped over 23%. In 2008, it fell close to 40%. Despite these massive declines, the long-term trend has been strongly upward, which proves the power of staying invested for the long haul. Let me give you the real power of dividends with actual numbers. As of late 2024, more than 80% of S&P 500 companies pay dividends. The average dividend yield is around 1.25%. Now here's where it gets crazy. A hypothetical $10,000 investment in an S&P 500 index fund at the end of 1993 would have grown to more than $182,000 by the end of 2023 if you reinvested the dividends. But if you took the dividends as cash instead of reinvesting them, you'd only have $102,000. That's an $80,000 difference just from reinvesting those dividend payments. This is the power of compound growth, where both your shares and your future dividends grow over time. But here's the warning nobody talks about. Dividends are not guaranteed. During the 2020 pandemic, 68 of the roughly 380 dividend-paying companies in the S&P 500 either suspended or reduced their payouts. This is why you can't just chase high dividend yields without researching whether the company can actually sustain those payments. So how do you actually start investing? Let me walk you through the 6 essential steps. Step 1 is choosing a broker and opening a brokerage account. This is a specialized account that lets you buy, sell, and hold investments. Many online brokers like Fidelity and Charles Schwab have no account minimums and offer commission-free trading on stocks and ETFs. The whole process takes about 15 minutes online. You'll provide your personal information, social security number, and employment details. They'll verify your identity, you'll link your bank account, and you're ready to go. Step 2 is funding your account. You can transfer money electronically from your bank, which usually takes 1 to 2 business days. Here's the great news for beginners. You don't need thousands of dollars. Many brokers now allow fractional share investing, meaning you can start with as little as $1 or $10 instead of waiting to afford full share prices. Step 3 is absolutely critical, and where most beginners fail. Research before you invest. Never, and I mean never, invest based on hype, social media tips, or even YouTube videos alone without doing your own homework. Read company annual reports. Understand their revenue and earnings growth. Know who runs the company and whether they have a successful track record. Understand if the industry is growing or declining. Check valuation metrics like price-to-earnings ratios to see if the stock is fairly priced. If this sounds overwhelming, here's the good news. Index funds and ETFs offer built-in diversification without requiring you to research individual companies. Step 4 is placing your order. There are 2 main types. Market orders execute immediately at whatever the current price is. You get your shares fast, but don't control the exact price. Limit orders let you set a specific price you're willing to pay. This gives you control, but your order might not execute if the stock never reaches your target price. Step 5 is monitoring your investments. Check your portfolio regularly, but don't obsess over daily price movements. Long-term investors should review quarterly or annually, not every day. Stay informed about company news and earnings reports, but resist the urge to constantly tinker with your holdings. Step 6 is holding for the long term. This is where compound growth works its magic. The longer you hold quality investments, the more time markets have to recover from downturns and grow overall. Most successful investors follow this principle. Invest consistently, avoid panic selling during crashes, and let time work in your favor. Now, let me teach you the 2 strategies that will put you ahead of 90% of traders. The first is dollar cost averaging. Instead of investing a large sum all at once when you think prices are lowest, you invest a fixed amount at regular intervals regardless of price. Imagine you have $1,200 to invest. Instead of investing it all today, you invest $100 monthly for 12 months. As prices fluctuate, you automatically buy more shares when prices are low and fewer shares when prices are high. This averages your cost per share over time and protects you from the regret of investing everything right before a market crash. This strategy eliminates timing risk, manages your emotions through automatic investing, and builds disciplined wealth creation habits. The second strategy is diversification, which simply means spreading your investments across multiple assets to reduce risk. If one investment performs poorly, others can offset the loss. Diversify across different asset classes by combining stocks, bonds, and potentially real estate. Diversify within stocks by owning companies from different industries. Include large-cap stable companies, mid-cap balanced companies, and small-cap growth companies. Consider both domestic and international investments. A simple beginner portfolio might look like 60% stocks, 30% bonds, and 10% in alternative investments or cash reserves. Let me address something that scares every beginner: market volatility. Volatility measures how quickly and dramatically prices move. High volatility means sharp price swings. Low volatility means gradual changes. What causes it? Economic data like inflation and unemployment reports, earnings announcements from major companies, interest rate changes from central banks, geopolitical events like wars or elections, investor emotions and herd behavior, and high-speed algorithmic trading systems. Here's what most people get wrong. Volatility isn't necessarily bad. It actually creates opportunities for patient investors. Let me prove it with a real example. After the market dropped 20% between December 2019 and March 2020 during the pandemic, U.S. equities rebounded within 4 months, returning to pre-crash levels by July 2020 and climbing even higher afterward. Investors who stayed invested benefited tremendously, while those who panic sold locked in their losses. You'll also hear about bull markets and bear markets. A bull market occurs when stock prices rise 20% or more from a recent low and stay up for at least 2 months. During bull markets, investor confidence is high, economic growth is strong, and more people enter the market expecting further gains. A bear market occurs when prices fall 20% or more from recent highs and stay low for at least 2 months. These signal economic weakness, high inflation, rising unemployment, or global crises. Here's what you need to understand. Bear markets are normal and temporary. They happen every few years on average, but markets eventually recover and reach new highs. Between 2000 and 2012, the market declined 54% and didn't fully recover for over a decade, but it did recover. In the 2019 to 2020 pandemic, the market fell 20%, recovered within 4 months, and reached new highs by the end of 2021. Before we wrap up, let me warn you about 6 deadly mistakes that destroy beginner investors. Mistake 1. Investing based on tips without research. Mistake 2. Trying to time the market perfectly, which is nearly impossible even for professionals. Research consistently shows that staying invested beats market timing. Mistake 3. Lack of diversification by putting all your money in one stock or sector. Mistake 4. Emotional decision-making driven by fear and greed instead of logic. Mistake 5. Ignoring risk management by investing money you need for bills or emergencies. Mistake 6. Falling for investment scams promising guaranteed high returns, which don't exist in legitimate investing. So here's your action plan. Start with education, which you're already doing right now. Begin small. Even $10 is enough to start learning. Use dollar cost averaging by investing fixed amounts regularly. Diversify immediately across different investments and industries. Consider S&P 500 index funds first, since they offer instant diversification and have historically delivered that 10% average annual return. Stay disciplined through market crashes by remembering the 2020 example. And finally, think in decades, not days. The stock market has been the greatest wealth-building tool in history for ordinary people. Your journey to financial freedom starts with a single step, and that step is making the decision to begin. If this video cleared up your confusion about investing, smash that like button. Subscribe for more beginner-friendly content that breaks down complex topics into simple actions. And comment below with your biggest investing fear so I can address it in future videos. Remember, the best time to start investing was 30 years ago. The second best time is right now. I'll see you in the next one. This video is for educational and informational purposes only. Investment performance shown is based on historical data and projections. Past performance doesn't guarantee future results. Always conduct your own research and consult with a qualified financial advisor before making any investment decisions. Thanks for watching.